Good morning, everyone. So in the previous class, we just completed Ind AS 1, right? So that is pertaining to disclosure of accounting policies. Today we'll be talking about Ind AS 2, that is nothing but inventory. Okay. So accounting standard 2 was also dealing with inventory, and even this Indian accounting standard 2 also deals with inventory. Alright. So let's straight away start with this Indian accounting standard 2. So first thing is we should be knowing what exactly is this inventory, right? You guys already know what is inventory. So the unsold goods which are left over at the end of each financial year, that will be treated as the closing stock, or you can also call it as closing inventory. Okay. So closing of 1 year will become the opening stock for the subsequent year. Now how are we going to account for this particular inventory? Okay. So when it comes to valuation, at what value are we supposed to show the inventory in our financial statement? That is what we'll be learning. Along with that, is there any additional disclosure which we are supposed to make while giving effect for this particular inventory in your financial statement? Even that we'll be learning today. All right. Okay, so let's look about this particular objective. The objective of this standard is to prescribe the accounting treatment for inventory. How are we going to give the accounting treatment for inventory? That is what is the main objective of this particular Indian accounting standard. This standard deals with determination of cost and its subsequent recognition as an expense, including any write down to the net realizable value. It also provides guidance on the cost formulas, okay, that are used to assign the cost of inventory. Now when it comes to inventory, it will be valued either at cost or net realizable value, whichever is less. Okay, lower of cost or net realizable value, that is what we use. Now when it comes to cost, what and all things will become the component of cost? Okay, so here they just give it in the form of formula. Okay, so that is nothing but the cost formula. So cost formula is nothing but the components of cost. When I say cost, what and all things will be included in cost? Okay, that is what will be dealt with this cost formula. And again, if at all you are valuing the inventory at net realizable value, or if at all you are writing down the value by some extent, okay, when it comes to inventory, if at all you are writing down, okay, if you are deducting some portion of the amount from the inventory, so what exactly is the treatment which we are supposed to give? That is what we'll be learning in this Indian accounting standard 2. Okay, so let me just write this. So Ind AS 2, this is pertaining to inventories. So when it comes to objective of this Indian accounting standard, objective is quite simple. We just need to understand what exactly is the treatment which we give for accounting of inventory. Look at this, accounting treatment for inventory. Okay, so it prescribes accounting treatment for inventory. Okay, so this is the first objective. To prescribe the accounting treatment for inventory. Alright, so this standard deals with determination of cost and its subsequent recognition as expenses, including any write down to the net realizable value. So at what value are we supposed to account for this particular inventory? Okay, so determination of cost, recognition of inventory as an expense, and subsequent reduction if any. Okay, so all these things will be dealt with this standard. So let's talk about the scope. Okay, so if you just remember this, 1 point more than sufficient when it comes to objective. Okay, so they would have given you a lot of practical illustration. That is what is relevant from examination perspective. Okay, so one question will definitely be asked from this particular accounting standard. Okay, so when it comes to scope, this standard is applicable to all the inventory except, okay, so financial instruments to be accounted under Ind AS 32, financial instrument presentation, and Indian accounting standard 9, financial instrument. See, when it comes to inventory, it will be dealing with all the inventories other than financial instrument. Why? Because for financial instrument, we have got a different accounting standard, that is Ind AS 32, which is financial instrument. So presentation, and Ind AS 109, which is financial instrument. Okay, so these two Indian accounting standard, Ind AS 32 and Ind AS 109, these are the standards which are dealing with financial instruments. So that is why when it comes to inventory, it will be talking about all the inventory except financial instrument and biological assets. So even biological assets are not covered within the scope of Ind AS 2. So what are biological assets? These are nothing but the livestock. Look at this, living animals or plants related to agricultural activity and agricultural produce at the point of harvest to be accounted under Ind AS 41, that is relating to agriculture. Okay, so scope of this standard. Now any standard if you take for that matter, it will be having its own objective and its own scope. Okay, so let's talk about the scope of this Indian Accounting Standard 2. So Ind AS 2 shall be applicable for all the inventories except two things. Okay, so one is financial instrument. Okay, so financial instruments, and then the next thing would be livestock. Okay, you can either call it as livestock or biological assets. Okay, so what is biological assets? It is nothing but the living animals or plants related to agricultural activities and agricultural produce at the time of harvesting. So at the time of harvesting, obviously they'll be having life, right? Whether it is plant or when it comes to animals. Okay, so these two things are not covered within the scope of Indian Accounting Standard 2. The standard does not apply to the measurement of inventory held by producers of agricultural and forest product, agricultural produce after harvest, minerals and mineral products to the extent that they are measured at net realizable value in accordance with well established practice in those industries, and it will not be applicable for commodity brokers, traders who measure their inventory at fair value less cost to sell. Okay, so these are the places wherein this particular standard is not applicable. Okay, so I'll just write this. So this standard is not applicable for measurement. Look at this. This standard does not apply for measurement of inventory. Okay, so for measurement of inventory held by two people. So one is agriculturist. Look at this. So producers of agricultural and forest product, agricultural produce after harvest, and mineral products. Okay, so producers of agricultural and forest product. Okay, so agricultural produce after harvesting. Okay, so even for that it is not included. Agricultural produce after harvest. If at all I want to measure the agricultural produce after harvest, will I be applying the concept of Indian Accounting Standard 2? No, we are not going to apply the same. Okay, so same way it will not be applicable for measurement of mineral and mineral products. Okay, so mineral and mineral products which are normally measured at net realizable value. Okay, so that they are measured at net realizable value in accordance with well established principles or practice. Okay, so which are measured at net realizable value. Clear? So same way this will not be applicable for commodity brokers. Okay, so when it comes to trading, okay, we can trade either in equity, F&O, that is futures and options, same way currency, and then commodities. Now when it comes to commodities, you guys would have heard, right? So oil product for that matter. Okay, so gold, silver, okay, zinc, iron, okay, or any other metal for that matter. All these commodities we can trade without buying these particular products. So if I say that I'm trading in gold, okay, it's not that I'm literally buying the gold and selling it. Okay, so we can trade it through online. Okay, so that is what is called as commodity market. Okay, so commodity market. So these commodity brokers, okay, so who are trader, they'll be measuring their inventories at fair value less cost to sell. Okay, so commodity brokers commodity broker traders who measure their inventory at fair value less cost to sell. We'll be learning what exactly is this fair value, what is fair market value, what is net realizable value, what is cost. All these things they have defined subsequently. We'll be learning all these things. Okay, so just remember that whenever it comes to valuation of agricultural produce after harvest, okay, or when it comes to valuation of mineral ores, okay, so forest product for that matter, And same way when it comes to commodities which are held by the commodity brokers, okay, we'll not be applying the concept of Indian Accounting Standard 2. Just remember this much. All right. Okay, so look at this. So they have given you important definitions. Okay, so let's learn about these definitions. So first thing is they have defined the meaning of the term inventory. So what are inventories? Inventories are assets. So the unsold goods, whatever is left out in our warehouse, we own it, right? Correct? So that becomes our asset. So inventories are asset which are held for sale in the ordinary course of business. So why are we holding this particular stock? What is our objective? Our objective is to sell it in the near future. Okay, so these are primarily held for the purpose of trading, that is to sell. In the process of production for such sale. Okay, so when I say for the purpose of sale, it is already in the finished goods stage. Okay, so sometimes we'll be holding inventory which will be used during the course of conversion of raw material into finished goods. Look at this, which will be used in the process of production for such sale. Okay, in order to produce the goods also I'll be having some stock. Okay, so these stock I'll not be directly selling, rather I'll be using it for the purpose of getting some end product. So in the form of material or supplies to be consumed in the production process or in rendering of services. Okay, these are nothing but raw material. So basically inventories is an asset which can be either in the form of raw material, work in progress or finished goods. Look at this. So raw material, what is it? It is the basic material or supplies which will be consumed in the production process or while rendering the services. Then work in progress. Okay, so in the process of production for such sale. Okay, so these stock will be held or will be used for the purpose of production of a particular end product which will be meant for sale. Okay, so and finally finished goods. Okay, these are held for sale in the ordinary course of the business. So inventory will be including three components: raw material, work in progress and finished goods. Clear? Hope you guys understood this. Just remember this much: inventories are nothing but the assets and it will be including the raw material, work in progress and finished goods. It need not necessarily include only those components which can be sold in the market. Even those components which will be used for the purpose of production of a particular unit which will be sold in near future, even that will be treated as inventory. That is nothing but your work in progress. Clear? Okay, let's talk about the next thing, that is net realizable value, NRV. Okay, so remember I told you inventory will be valued either at cost or net realizable value, whichever is less. Now when I say to realize, what does it mean? It means to receive, right? I sell something and I realize some cash. Okay, so to realize is nothing but to receive. Okay, let's say I sold a vehicle and realized 30,000. What does it mean? I sold vehicle and I received 30,000. So realizable is nothing but the amount which I am going to receive. Okay, look at this. Net realizable value is the estimated selling price. Okay, so estimated selling price in the ordinary course of the business less, okay, estimated cost of completion and estimated cost necessary for the purpose of making this particular sale. Okay, now let me explain this with the help of an example. So net realizable value, as I already told you, this is nothing but the amount which I am going to receive. Okay, so let's say, yeah, you have a particular product. Okay, so let's say it is product A. Okay, you have a particular product, let's say it is product A. Now this particular product, okay, so the cost, you will be able to determine what exactly is the cost. Okay, so cost is, let's say, 8,000 rupees. That is, you spend 8,000 rupees in order to get this finished goods A. Now when it comes to net realizable value, okay, so this particular product has to be valued either at cost or net realizable value, whichever is less. Clear? Now how am I going to determine this net realizable value? You know that net realizable value, or to realize, is nothing but the amount which I will be receiving. If I sell this particular product in the market today, what exactly is the amount which I am going to receive? Okay, so that is why they use the term called as estimated selling price. Clear? So estimated selling price. If I sell this particular product today, how much exactly is the amount which I am going to receive? Okay, so that is estimated selling price. From this, you will be deducting few things. Okay, so what are those things? The first thing is estimated selling price less what? Less estimated cost of completion. If at all there is some additional expenditure which you are supposed to incur for the purpose of completing this particular goods. Now let's say This goods is 95% complete. Okay, another 5% is yet to be completed. So you will be spending some amount towards it, right? Correct. So less estimated cost of completion. Okay, and same way you will be deducting any other additional expenditure which is necessary for the purpose of sale. Okay, so if you see over here, look at this. Less estimated cost of completion and estimated cost which is necessary for the purpose of sale. Okay, so from this you will just be deducting estimated cost necessary for sale. Now let me explain this with the help of figures. Okay, so suppose if I sell this particular product in the market today, I'll be able to receive, let's say, 10,000 rupees. But it is not in a completion stage. Okay, you will have to spend some additional amount for the purpose of completion. Let's say you will have to spend another 1,000 rupees and any other expenditure which is necessary for the purpose of sale. Now let's say you will have to spend some amount towards proper packing of this particular product. Now for the purpose of packing, let's say 800 rupees is what you will have to spend. Now how much would be the net realizable value? The net realizable value over here would be how much? 8,200. Correct? 8,200 rupees would be the net realizable value. So this particular inventory should be valued either at 8,000 or 8,200, whichever is less. So it will be valued at 8,000 rupees. Very simple concept, guys. So when I say net realizable value, it will be simple thing. Estimated selling price. If I sell this particular product in the market today, I'll be able to realize 10,000. From this, don't you think you will be spending these two amounts? So estimated cost of completion 1,000 rupees and estimated other cost which is necessary for the purpose of sale. Don't you think 1,800 you will be spending? How much is the net amount which you will be receiving? So that is why they use the term net realizable value. The net amount after spending all the amount which you will be receiving would be how much? It would be 8,200. Okay, so 8,200 is the amount which you are going to receive. Now you will have to compare this with the cost. Whichever is lower, that is the amount at which inventory will be valued. Is this point clear? Hope you guys understood this. Okay, so let me just write this amount or this particular formula in the notes. Net realizable value. So same way subsequently they would have given you the formula for cost also. We'll be looking into that particular aspect also. So net realizable value will be equal to estimated selling price minus estimated cost of completion minus estimated expenses necessary for sale. Now for the purpose of selling this particular product, if at all I want to incur any expenditure, even those expenses will be deducted from here. Is this clear? If you just remember this much, more than sufficient. Okay, so let's talk about the next term, that is fair value. Okay, so what exactly is this fair market value? So fair value is the price that would be received to sell an asset or paid to transfer a liability in the ordinary transaction or in an orderly transaction between market participants at the measurement date. So between known people, okay, so whatever is the price at which a particular asset will be sold or a liability will be settled. Okay, so that is what is called as fair value. So what is fair value? It is the price that would be received to sell an asset or paid to transfer a particular liability in an ordinary transaction or orderly transaction between market participants at the measurement date. On a particular date, at what price are you transferring this particular asset or liability? That particular price itself will be treated as what? Fair value. Okay, so not much important again. So measurement of inventory. Okay, so how exactly are we supposed to measure the inventory? Inventory will be valued either at cost or net realizable value, whichever is less. So net realizable value we have already understood, right? So let's talk about this cost component. So inventory shall be measured at lower of cost and net realizable value. Okay, so when it comes to measurement of inventory, measurement or valuation of inventory, inventory shall be valued at lower of cost or net realizable value. Clear? So inventory will be valued either at cost or net realizable value, whichever is lower. Okay, now when it comes to cost of inventory, okay, so what and all things will be included? Look at this. So when it comes to cost of inventory shall comprise all the cost of purchase, cost of conversion and other costs incurred in bringing the inventory to their present location or condition. So mainly when it comes to cost, okay, so I'll just write this. Cost of inventory shall include three things. Okay, so it shall include three things. So first thing is cost of purchase. The second thing is cost of conversion. Look at this. We find this cost of purchase, cost of conversion and other costs which are incidental to bring this particular inventory to the present location or condition. Okay, so cost of purchase, cost of conversion, and then lastly it will be including what? Other costs which are incidental with bringing the inventory to the present location or condition. So it will be including not only the cost of purchase but also the cost of conversion and other incidental expenses which were necessary in order to bring the inventory to the present location or condition. Alright. So here they have given you explanation in detail, like what exactly is the cost of purchase. Okay. So what exactly is this cost of conversion, and same way they have explained what exactly are the other costs which are necessary or incidental for the purpose of bringing the inventory to the present location or condition. Clear? So let's talk about these three. So when it comes to cost of purchase, quite simple, right? The amount which you actually spent, okay, in order to get these particular product, that will be treated as cost of purchase. Look at this. The cost of purchase of inventory comprises of purchase price, import duty and other taxes other than those subsequently recoverable by the entity from the taxing authorities, any transportation, handling and other costs directly attributable to the acquisition of the finished goods, material and services. Trade discount, rebates and other similar items are deducted in determining the cost of product. So when it comes to cost of purchase, what exactly is the amount which I am supposed to pay? Okay, so if at all there is any additional tax which I am supposed to pay, okay, like custom duties and other things, import duties, all these things. So these things also will be forming part of my cost component. Okay, look at this. So purchase price, import duties and other taxes other than those subsequently recoverable by the entity from the taxing authorities. So other taxes which I am able to recover from the taxing authorities, I am not supposed to add it to the component of cost of purchase. Alright, so I'll just write this. So when it comes to cost of purchase, it shall include, so it shall include the purchase price, import duty and other taxes, okay, other taxes other than those which are recoverable subsequently. Okay, so other than other than those which are subsequently recoverable by the entity from the taxation authorities, other than those which are subsequently okay, so import duties and other taxes, and then it will also be including the transportation and handling costs. Okay, look at this. Transportation, handling and other costs directly attributable to the acquisition of finished goods. Okay, so transportation, which are directly attributable okay, so which are directly attributable for acquisition of goods, material and services. Okay, so acquisition of goods or services. Clear? So same way, if at all there is any trade discount, okay, so if at all there is any trade discount, rebates and other benefits, will just be deducting. Look at this, trade discount, rebates and other similar items are deducted while determining the cost of purchase. So even if you guys see this particular invoice, don't you think all the discount and rebate will be deducted? Same point. So trade discount, rebate and other items shall be deducted while determining the cost of purchase. So while determining the cost of purchase, if at all we come across any discount or rebate, we just need to deduct it. Very simple, guys. Okay, so when it comes to cost of purchase, look at this. So cost will be including what? One is the cost of purchase, okay, another thing is the cost of conversion, and then other cost, okay, which is necessary in order to bring the inventory to the present condition or location. Now we are talking about the cost of purchase. Okay, so we are talking about the cost of purchase. Now when it comes to cost of purchase, what and all things will be included? So one would be, look at this, it would be the purchase price less import duty or other taxes which I will not be able to recover in the near future. Okay, so plus transportation and handling cost, look at this, it will be including transportation, handling cost and other expenses which are directly related to the acquisition of goods or services. Same way, if at all I come across any trade discount, okay, so any trade discount or rebate, I'll just be deducting these two items. So trade discount and rebate, you just need to deduct them. So whatever amount you get over here, this will be treated as cost of purchase. Is this point clear? Hope you all understood this. Clear? All right. Alright, now let's talk about the next component of cost, that is cost of conversion. So one is cost of purchase, cost of conversion and other costs which are necessary to bring the product to the present location or condition. Okay, let's talk about the cost of conversion. So when it comes to cost of conversion, it consists of what? Okay, so direct production cost, that is direct labor, direct material and direct expenses. So all these terminologies you guys must be familiar and you would have learned when it comes to cost sheet. Okay, similar thing. Look at this, production overhead based on normal capacity expected on an average under normal circumstances, joint product cost. Okay, so just remember these three things. See, when it comes to cost of conversion, what is cost of conversion? To convert a raw material into finished goods, what are the other expenditure which will be incurring? So that is nothing but the production cost. What is production cost? It must be direct labor, direct material and direct expenses. All these three put together, if you guys are aware, we'll be calling it as what? We'll be calling it as prime cost, right? These three items put together, these are called as prime cost. Clear? So it includes direct labor, direct material and direct expenses and production overhead based on normal capacity, joint product cost. Sometimes if at all you are spending some amount towards the joint product, even that will be included over here. Okay, so I'll just write it over here. Cost of conversion okay, so this will mainly include what? It includes or it consists of the first thing is direct production cost, then production overhead and then joint product cost. Direct material, direct labor and direct expenses. So these three put together are nothing but your prime cost. Okay, so these three put together are nothing but your prime cost. So along with this production cost, it will also be including your production overhead. Okay, so look at this, it includes your production overhead. Based on normal capacity. And then lastly, it will be including the joint product cost. Okay, so sometimes if you are spending some amount towards the joint product, entire joint product cost also will be forming part of cost of conversion. Okay, just remember this much more than sufficient. So production overhead, so here they are telling production overhead, this can be of two types. So it can be either fixed overhead or variable overhead. Okay, do you know what is fixed overhead and variable overhead, right? So when it comes to fixed overhead or fixed cost, this will remain constant. Okay, so this is not going to change with the level of output or level of production. This is going to remain same. Rent, for that matter, it is fixed cost, right? So it doesn't matter whether I produce 1000 units, 2000, 5000 or 0 units, for that matter, the same amount of rent is what I'm going to pay. So fixed cost will always remain fixed. Okay, but when it comes to variable cost or variable overhead, this is going to change with the increase or decrease in the level of production. Higher the number of units, higher would be the variable cost. Okay, so normally it's like this: fixed costs are fixed in total but vary per unit. Okay, whereas variable cost varies in total but remain fixed per unit. Okay, so if you want, I'll just give you an example of fixed cost and variable cost. Okay, so let's talk about fixed cost first. So when it comes to fixed cost, let's take an example of rent. Suppose you're paying 10,000 rupees of rent. Now this particular rent is not going to change. Okay, so here I'll take three scenarios. Okay, so one place I'm producing 100 units, another place I'm producing 1000 units, another place I'm producing, let's say, 2000 units. Now doesn't matter whether you produce 100 units, 1000 units or even 2000 units, how much is the rent which you will be paying? Same 10,000, right? So 10,000 rent over here, 10,000 rent over here, and even in this case you will end up paying only 10,000. So in total, if you see, is this amount changing? No, this is constant or fixed. Okay, that is why it is called as fixed cost. But per unit, if you guys calculate, okay, so this will be how much? So 10,000 divided by 100, so this would be like this: 10,000 divided by 100 units. So this would be like 10,000 divided by 1000 units. This would be like 10,000 divided by 2000 units. So per unit, if you guys calculate, so this would be how much? 100 rupees per unit, and this would be like 10 rupees per unit, and this would be like 5 rupees per unit. Look at what is happening. Fixed cost remains fixed in total, but per unit it would vary. So when you were producing 100 units, it was 100 rupees per unit. When you increase the level of output to 1000, per unit the cost became 10 rupees. Same way, if you increased the level of output to 2000, per unit it became 5 rupees. So fixed cost remains fixed in total but varies per unit. Same way, if I talk about variable cost, okay, so variable cost, let's say raw material cost per unit. So raw material cost, okay, let's say it costs you 10 rupees per unit. Clear? So if I take the same example of 100 units, 1000 units and 2000 units, okay, so how much would be the total cost over here? 100 into 10, this would be like 1000 rupees, this would be like 10,000 rupees, and here it would be like 20,000 rupees. This would be the total variable cost. Okay, so what is happening to the total? So total, if you see, it is varying. Okay, with the increase in the level of output, the variable cost is also increasing. Okay, so higher the number of output, higher would be the variable cost. In total, it is varying. Okay, so from 1000 it became 10,000, from 10,000 it became 20,000. But per unit, everywhere if you calculate, don't you think it is 10 rupees per unit, 10 rupees per unit, and even here it is 10 rupees per unit? Yes. So what do you understand by this particular observation? So variable cost varies in total but remain fixed per unit. Fixed cost remains fixed in total but varies per unit. Try to remember this particular point. Clear? Okay, so the same point, whatever we learned, that is more than sufficient in order to understand the fixed overhead and variable overhead. That would be more than sufficient. Okay. Then other costs. What would be the component of other costs? Other costs which are necessary in order to bring the product to the present location or condition. Look at this. Other costs are included in the cost of inventory only to the extent that they are incurred in bringing the inventory to the present location or condition. For example, it may be appropriate to include the non-production overhead or the cost of designing product for specific customers, okay, in the cost of inventory. Now let's say one of the particular person, okay, placed an order for a customized product, okay. So we want to produce the goods as per his requirement. So what we do is we appoint a particular designer, okay, who will be designing the product according to the specification of that particular person. So the amount what I pay to the designer, even that would be forming part of cost of my inventory. So other expenses which are necessary in order to bring the product to the present location or condition. I want to bring the product to the condition which is prescribed as per the customer. For that I appoint a particular designer. So he'll be designing the product as per the requirement of the customer. So I need to pay him some amount, right? So this amount what I pay as designer's fee, even that would be included as a part of component of cost of inventory. Is this clear? Hope you guys understood this. Okay, look at this. Ind AS 23 borrowing cost identifies limited circumstances wherein borrowing costs are included in the cost of inventory. Normally, when it comes to borrowed money, it will not be forming part of inventory, but there are certain limited cases wherein even that would be forming part of our cost of inventory. Okay, so after this, they have given you a note. So an entity may purchase inventory or define settlement terms when the arrangement effectively contains a financial element, that the element, for example, a difference between the purchase price for normal credit terms and the amount paid is recognized as interest expenses over the period of financing. Now, this will not be treated as cost of the inventory. Now, let's say I had sold the goods at so and so price on credit basis. Now, subsequently, I had given a credit period of, let's say, 3 months. If he is taking more than 3 months to settle the amount, obviously, I will be collecting some interest amount. Will that interest amount be forming part of my cost of inventory? No. That's not going to form part of your cost of inventory. Okay, so just remember the point, whatever I write in the notes, more than sufficient. Okay, so here production overhead can be either fixed or variable. Okay, so then the next thing would be other cost. Other cost shall be considered for valuation of inventory only to the extent of those amount which are necessary in order to bring the inventory to the present location or condition. Is this clear? So other costs will be included as a part of cost of inventory only to the extent of that particular portion which is necessary in order to bring the inventory to the present location or condition. Okay, so I'll just give you an example. Mr. A placed an order for a customized product. The business entity appointed a designer to design the product as per the requirement of Mr. E. Okay, who is our customer. Okay, so the amount paid to the designer will also be considered as a part of cost of inventory. Okay, so the amount paid to the designer shall be considered as other costs necessary to bring the product to the present condition, and therefore shall be treated as component of cost of inventory. Hope you guys understood this. Okay, so the amount which is paid by the business entity towards the designer's fee, okay, even that would be included in the cost of inventory, even that would be treated as other cost which is necessary for the purpose of bringing this particular inventory to the present condition, and it will be considered as a part of cost of inventory. Clear? Okay, so these are the three things which will be included in the inventory. Very simple thing. So what are the three things which will be included in the inventory? So when I say cost, it will be including three things. Okay, so what are these three things? So one is cost of purchase, cost of conversion, and then other cost necessary to bring the inventory to present location or condition. Hope you guys understood this. Okay, so these are the three components, okay, which are included in the cost. Now when I say exclusion from the cost, okay, so what are the things which will be excluded? This is also important. Okay, there are few things which you need not include it. Okay, so while determining the cost of inventory, look at this exclusion from the cost of inventory. What are the things which are excluded from the cost of inventory? Example of cost excluded from the cost of inventory and recognized as expenses in the period in which they are incurred are abnormal amount, okay, of wasted material, labor and other items. So any abnormal item you just need to exclude it. It will not be forming part of your cost of inventory. Storage cost, unless those costs are necessary in production process before and further production stage. So any storage costs which you are incurring after the goods are already reached the finished goods stage, okay, so that is what is this amount which should be excluded. See, before the goods have been converted into finished goods, if you guys are storing it, okay, so and the amount whatever you are spending towards the storage, yes, that would be forming part of your cost. But once the goods have already reached the finished goods stage, after that if you are spending some amount towards the storage cost, that is not going to get included in the component of cost. Okay, so administrative overhead that do not contribute in bringing the inventory to the present location or condition, selling costs, all these are your indirect expenses, right? Correct. So these things will not be forming part of your cost of purchase. Okay, so the cost of purchase shall exclude the following. So what and all things will be excluded? First thing is abnormal items, storage cost of the goods after they have reached finished goods stage. Alright, so then the administrative cost, okay, which are not necessary for the purpose of bringing the inventory to the present location or condition, and then selling cost. Okay, you can just write it as administrative cost. So administrative cost and selling expenses, these are the items which will not be forming part of your inventory. Okay, just remember this much. Okay, so after this, cost of inventory of service provider. Okay, if at all a particular person is renderer of services, okay, so he's not selling the goods, he's rather rendering the services. At that point of time, how exactly do you value his inventory? Okay, so let's understand this. Okay, let's understand this. When it comes to service providers, how exactly are we going to value their inventory? See, to the extent that service providers have inventory, they measure them at their cost of the production. So the cost consists primarily of the labor and the other cost of personnel directly engaged in providing those particular services, including supervisory personnel and attributable overhead. Okay, so normally when it comes to this particular service providers who are including, okay, or who are having some inventory in their stores. This will be valued at cost, and that cost will be mainly consisting of what? It will be consisting of primarily the labor cost, and this particular labor cost will be the cost of the personnel directly engaged in providing those services, or if at all they have appointed some supervisors, even the amount whatever they pay to the supervisors, even that will be forming part of the cost. Okay, so labor and other costs relating to the sale and administrative personnel are not included. So anything relating to administration and selling expenses, these are indirect expenses, they will not be forming part. Look at this. Labor and other costs relating to selling and administrative personnel are not included but are recognized as expenses in the period in which they are incurred. So they are recognized as indirect expenses but not for the purpose of valuation of inventory. The cost of inventory of service providers does not include profit margins or non-attributable overhead that are often factored in simple price charged by the service provider. See, whenever I say cost of the inventory, when I say cost, it will not be including any profit margin. Not only the service provider but also any other thing for that matter, it will not be including the profit margin in it. Is this clear? Hope you guys understood this. Okay, so I'll just write it over here. So valuation of inventory by service provider. Inventory shall normally be valued at cost of production. By the service provider. Okay, so labor costs shall be the primary component. Okay, so labor cost, whether it is the labor cost which is paid to the supervisors or personnel, okay, who is directly engaged in providing the service. Okay, so that will be forming part of this particular cost of inventory. Administrative and selling expenses do not form part of cost of inventory. Clear? So then cost of agricultural produce harvested from biological asset. Okay, so how exactly do we value these agricultural produce? In accordance with Ind AS 41, that is relating to agriculture, inventories comprising agricultural produce that an entity has harvested from its biological assets are measured on its initial recognition at the fair value less cost to sell at the time of harvest. So this is the cost of inventory at that date for applicable or application of this particular standard. Okay, so when it comes to valuation of agricultural produce, okay, so after harvest, so these agricultural produce which are harvested using the biological assets, how are we supposed to value them? Look at this. These will be valued at fair value. So here the important thing is what? It should be valued at fair value. Look at this. Are measured on initial recognition at their fair value less cost to sell. Okay, so it shall be valued at fair value less cost to sell. Okay, so what exactly is the fair value? So what is fair value? We have already understood the meaning of this particular term, right? So look at this. Fair value is the price that would be received to sell any particular asset or to transfer a liability in an orderly transaction between the market participants at a particular measurable date. Clear? So the price at which I am selling a particular asset or exchanging a particular liability, okay, so in a particular market on a particular date, that is what is called as fair value. Clear? So then they have given you the techniques for measurement of cost. Okay, so let's look into this. So techniques for measurement of the cost of inventory such as the standard cost method or the retail method may be used, okay, for convenience if the results approximate cost. Standard cost take into account the normal levels of material supplies, labor efficiency and the capacity utilization. They are regularly reviewed and if necessary revised in the light of the current condition. Okay, so the retail method is often used in the retail industry for measuring this particular inventory. Now, when it comes to measuring this particular stock, different techniques will be used by different industry. Okay, so like we have got standard cost method and retail method. Okay, so retail method, where do we use it? So for measuring the inventory of large number of rapidly changing items with similar margin, for which it is impracticable to use other costing methods. Okay, so here whenever there are large number of rapidly changing items, okay, so wherein the profit margin is less, we'll be using this particular retail method. Not much important again. Okay, so cost formula. Okay, so when it comes to cost, you know the component of cost, right? So cost of purchase, cost of conversion, and other costs which is necessary for the purpose of bringing the product to the current location or condition. So cost formula, let's talk about this cost formula. Specific identification method for determining the cost of inventory. So specific identification method means directly linking the cost with specific item. Okay, so I'll be able to link that this amount is being incurred for this particular product only. Okay, there are no such common expenses wherein same expenses is being incurred for 2 or 3 different products. No, so this expenses is exclusively for this particular product. I can build that particular link. This amount was spent on this particular product, this amount was spent on so and so product. Okay, look at this. Specific identification method means directly linking the cost with specific item of inventory. Okay, so this method has application of the following condition. In case of purchase of an item specifically segregated for specific project and not ordinarily interchangeable. So this particular method will be used where, so this will be used in those industry wherein you will not be able to interchange a particular product. Okay, so this is specifically segregated for specific project, okay, which is not internally or not ordinarily interchangeable. In case of goods or services produced and segregated for a specific product. So sometimes I'll be producing the goods for a specific project. Even at that point of time, the same method will be used for the purpose of valuation. When specific identification method is not applicable, at that point of time, we have got quite a few methods. FIFO method, that is first in first out, and weighted average method. Okay, so all these things you guys would have learned at your foundation level. Okay, so different methods of valuation of inventory. We have got FIFO method, LIFO method, simple average method, weighted average method. Okay, so these are the methods. So wherein I don't have any specific identification approach, in that case I'll be following this FIFO method or weighted average method. Clear? Okay, let's talk about net realizable value. Net realizable value we have already discussed, right? The meaning. So net realizable value is nothing but the amount which I am going to receive. And how do we calculate it? The estimated selling price minus the estimated cost of completion minus estimated other cost which is necessary for the purpose of selling this particular product. Okay, if you remember this much, more than sufficient. Look at this. The cost of inventory may now be recoverable if those inventories are damaged. Okay, if they have become wholly or partially obsolete, or if selling price have been declined. The cost of inventory may also not be recoverable if the estimated cost of completion or the estimated cost to be incurred to make the sale has increased. So the practice of writing inventory down below the cost to net realizable value is consistent with the view that asset should not be carried in excess of the amount expected to be realized. Remember, we had one of the accounting concept called as prudence concept or conservatism. Yes. Now let us say the cost of a particular product is 10,000. Okay, this is the cost. And then we have got net realizable value as 8,000. Now I'll be writing down this particular cost. Okay, cost is 10,000. I'll be showing this reduction of 2,000 and I'll be recognizing the inventory at 8,000 rupees. That is what is this point which they have explained. Read this. The practice of writing inventory down, okay, below the cost to net realizable value is consistent with the view that assets should not be carried in excess of the amount expected to be realized from their sale. So at any point of time, if the expected amount which I am going to realize, okay, if it is lesser than cost, then inventory should be valued at such amount. So what I do is the cost whatever is been already appearing in my financial statement, I'll be reducing it to the extent of net realizable value, because asset should not be shown at a particular value which I'll not be able to recover. Look at this. Asset should not be carried in excess of the amount which is expected to be realized. Okay, so asset value in my balance sheet or financial statement should not be exceeding the amount which I am expecting to realize. Alright. Just remember this much, and you already know the formula with respect to the same. Okay, estimated selling price minus estimated cost of completion minus estimated other cost which is necessary for the purpose of sale. Anybody having any doubt, any confusion? Clear? So let's talk about this next part, that is recognition as an expense. Now when it comes to this particular stock, okay, how are we going to recognize it as an expense? When inventories are sold, okay, so when inventory or the unsold goods are sold, the carrying amount of those inventories shall be recognized as an expense in the period in which the relevant revenue is recognized. Okay, so the amount of any written down value of the inventories to the net realizable value and all the losses of the inventory shall be recognized as an expense in the period in which the write down or loss occurs. Now here if you see, the cost was 10,000 whereas net realizable value was 8,000. So I need to reduce it to the extent of 2,000. So this 2,000 rupees will be recognized as what? It will be recognized either as an expense or it will be recognized as loss. So in my P&L account on the debit side, I'll be showing this particular reduction in the value of inventory. The amount of any reversal of any write down of inventory arising from an increase in the net realizable value. Okay, so subsequently if there is any increase in this particular net realizable value at that point of time, what are we supposed to do? All right. Hope you guys understood this. Clear? Yes. So any reduction whatever we make from the value of inventory, suppose cost was 10,000, net realizable value was 8,000. So this 2,000 rupees of reduction will be recognizing it as an expense in the P&L account in that particular year. Same way, if at all there is any subsequent increase, look at this. What do they say? The amount of any reversal of any written down of the inventory arising from increase in the net realizable value shall be recognized as a reduction in the amount of inventory recognized as an expense in the period in which the reversal occurs. So some inventories may be allocated to other assets account. For example, inventory used as a component of self-constructed property, plant or equipment. Inventory allocated to another asset. See, sometimes what will happen is we have already reversed this particular amount. Subsequent year, okay, so now the value of the inventory is 8,000. Subsequent year, there is increase in this particular net realizable value. Cost was 10,000, 8,500 is the net realizable value. Subsequently, there is increase in the net realizable value. So we need to reverse this 500 rupees. So whatever is the 500 rupees which we had reduced from the inventory, it will be added to the inventory, okay, as other component of self-made assets. Is this clear? Not much important again. Let's talk about the last part, that is disclosure. Okay, so disclosure relating to the same. The financial statement shall disclose the following: the accounting policy which was adopted for the purpose of measuring the inventory, the carrying amount of inventory and the carrying amount in classification of appropriate item of the inventory. How much is the carrying amount of raw material? How much is the carrying amount of work in progress? How much exactly is the carrying amount of finished goods? The carrying amount of inventory carried at fair value less cost to sell. So normally when it comes to agricultural produce, we'll be using this particular approach: fair value less cost to sell. The amount of inventory recognized as an expense during the year. Okay, if at all there is any written down value, okay, or if at all there is any reduction in the value of inventory to bring the value of the inventory to the net realizable value, at that point of time we just need to deduct some amount from the cost. So such reduction in this particular value of inventory has to be disclosed separately. The amount of any write down of the inventory recognized as an expense in that particular year, the amount of any reversal of any write down, okay, so any amount which has been reversed. So earlier I had reduced it, now I'm just reversing it, even that has to be disclosed. The circumstances or events that led to reversal of write down of the value of inventory, the carrying amount of inventory is pledged as security for liability. If at all you have pledged this particular inventory as collateral security, okay, in that case also you will have to just make a separate disclosure. Is this clear? All right. So that's all. If you remember this much, more than sufficient. So these practical illustration is what is important from examination perspective. As I already told you earlier, one question will definitely come from this particular Indian Accounting Standard 2. Okay, so let's look into this. So 90% possibility they'll be asking a practical question from this particular Indian Accounting Standard 2. Let's look into this. So how do you deal with the following? On 31st March 2021, the closing stock of Gaurav Limited included 10,000 units costing 10 rupees, that is 1 lakh. 10,000 into 10 rupees, 1 lakh. But the current market price at the date was 9 rupees, that is 90,000. See, this 90,000 is the market value, current market value. If I sell these goods in the market today, how much is the amount which I'll be realizing? I'll be realizing only 90,000 rupees, right? So this becomes the net realizable value. Okay, this becomes the net realizable value. Cost over here is 1 lakh, net realizable value is 90,000. So inventory will be valued either at cost or net realizable value, whichever is less. Okay, so let's just solve this illustration. Quite simple. So in this case, okay, so cost they have already given. Okay, so cost is how much? 1 lakh. Okay, so what about net realizable value? Net realizable value is 90,000. Inventory shall be valued at lower of cost or net realizable value. Okay, so therefore the inventory should be measured at rupees 90,000 in this case. Okay, so inventory will be valued at what price? 90,000. Check out the solution. According to Indian Accounting Standard 2, valuation of inventory will be lower of cost or net realizable value. So in the present case, cost is 1 lakh rupees, net realizable value is 90,000. Therefore, inventory will be valued at 90,000 rupees, that is net realizable value. Is there any complication with respect to this illustration? Nothing, right? Quite simple. All right. So let's quickly move on to this illustration number 2. From the following information presented by P Limited, ascertain the value of the stock to be included in the balance sheet. So cost price of certain stock amounted to 60,000 being obsolete. So this is outdated stock. Okay, it can be used for production purpose after incurring 10,000 rupees for modification. The same can be used as raw material for existing product. The purchase price for the same amounts to 40,000 rupees. Okay, so now they are telling at what price will you be valuing this particular inventory. See, what is the cost price? The cost price is 60,000, which has become obsolete. Okay, so it can be used for the purpose of production after incurring 10,000 rupees towards modification expenses. Okay, the same could be used as raw material for an existing product. The purchase price for the same would be how much? It would be 40,000 rupees. Okay, at what price are we supposed to value the inventory? Look at this. Cost price which is given 60,000 rupees is the cost price. Okay, cost price of certain stock which has become obsolete, it is 60,000. What about net realizable value? Look at this net realizable value, 40,000 minus 10,000. What is this 40,000 minus 10,000? If at all I purchase raw material separately, look at this. It can be used for production purpose after incurring 10,000 rupees towards modification. The same could be used as raw material for an existing product. The purchase price of the same is 40,000. See, if at all you purchase similar product, you will have to spend 40,000 rupees. Here, are you supposed to spend it? No. You already have some existing goods. The only amount which you need to spend is how much? It is 10,000 rupees. Okay, so 10,000 rupees towards the modification. Okay, so inventories are valued at lower of cost or net realizable value. Hence, 30,000 should be treated as the value of the stock, which is included in the balance sheet. Clear? Okay, so let me just write this illustration in simple terms. So illustration number 2. So in this case, the cost is given. How much is the cost? Cost is straight away given as 60,000 rupees. So net realizable value, you know. Okay, so net realizable value will be estimated selling price minus estimated cost of completion minus estimated cost necessary for sale. Now here if you see finished goods, okay, so this particular product will be acting as raw material. So in the market, if I purchase, I'll be able to purchase it at 40,000. It means even if I'm able to sell it, the value of this would be 40,000. So for this particular amount, I need to spend 10,000 rupees towards modification. Okay, so out of 40,000, whatever I receive, 10,000 I need to spend towards modification. So net realizable value will just be 30,000. Okay, so as per Ind AS 2, inventory shall be valued at lower of cost or NRV. Okay, so in this case NRV being lower, inventory shall be valued at what price? It shall be valued at 30,000 rupees. Okay, so which is the net realizable value. Is there any doubt, any confusion? All simple illustrations, right? All right, so let's look into this illustration number 3 now. So how will you deal with the following situation? Okay, so they have given you quite a few situations and they're just asking us how exactly are we going to deal with these situations. A company deals in purchase and sale of timber and has included notional interest charges calculated on the paid up share capital and free reserves in the value of the stock of timber as at the balance sheet date, okay, as part of the cost of holding the timber. Okay, so here what are they telling? They are dealing in timber, okay, which is nothing but a agricultural product or a forest produce. Okay, so at what value are we supposed to do the valuation of this particular inventory or show the valuation? Look at this. They are including some notional interest. Can we include that notional interest? That is the question. Okay, look at this. According to Indian Accounting Standard 2, inventories, interest and other borrowing costs are usually considered as not relating to bringing the inventory to the present location or condition. Okay, so these are not considered. Okay, so these are not considered as part of the cost of this particular inventory. So these are not considered as other costs which are necessary for the purpose of bringing the inventory to the present location or condition. Okay, so borrowing costs are usually considered as not relating to bringing the inventory to the present location and condition, are therefore usually not included. So this particular notional interest should not be included in the cost of the inventory. Hence, the valuation of closing stock of timber cannot be considered as it is not in conformity with Indian Accounting Standard 2. So this particular borrowing cost or interest or any other notional interest cost should not be considered as a cost of inventory. It is not considered as other cost which is necessary for the purpose of bringing the inventory to the present location or condition. We already discussed this. If you see, I'll just show you guys. Somewhere we discussed, right, borrowing cost. Okay, so it will not be forming part of your inventory cost. That is what we discussed, right? So somewhere, yeah, here it is. Look at this. Okay, so other costs and include the cost of inventory only to the extent that they are included in bringing the inventory to the present location or condition. For example, it may be appropriate to include non-production overhead as cost of designing. This we discussed. Okay, look at this. Borrowing cost identifies limited circumstances where borrowing costs are included in the cost of inventory. So normally when it comes to borrowing cost, it does not form part of your cost of inventory. Only there are limited circumstances which is explained in Indian Accounting Standard 23. Okay, so borrowing costs usually do not form part of your cost of inventory. We already discussed this point, right? So this illustration 3 is based on that point. Okay, so let's look into this illustration number 4. The company deals with 3 products A, B and C which are neither similar nor interchangeable products. So specific, okay, valuation is what we are supposed to do. At the time of closing its account for the year 2021, the historical cost and net realizable value of the item of closing stock are determined as, so this is the cost, okay, item A, and then this is the net realizable value. Item B, 32 lakh is the cost and 32 lakh is the net realizable value. Item C, 16 lakh and 24 lakh. So usually what they'll do is in the examination they'll also give you the total. Okay, so total of this would be how much? 40, 70, 80, 88, right? So this would be 88 lakh, and what would be the total of this? 30, 50, 60, 84. So what mistake we'll do is we'll just focus on total. Total cost is 88, total net realizable value is 84, inventory will value at 84. No, that is absolutely wrong. So when it comes to valuation of inventory, we'll have to do it separately. Okay, for product A, valuation has to be done separately. For product B, valuation has to be done separately. Same way for product C, the valuation has to be done separately. Okay, so here when I do the valuation, I just need to remember one point. Okay, so inventory will be valued either at cost or net realizable value, whichever is less. Look at this. So historical cost or net realizable value, whichever is less. Okay, so here if you see, this is the least amount, right? 28 lakh. So product A will be valued at 28 lakh. Product B will be valued, it is same. Okay, so this would be valued at 32 lakh, and here the least amount is 16. This would be valued at 16 lakh. So if you see the total, how much would be the total? 50, 60, 76. Okay, so 76 lakh rupees would be the value of inventory. Okay, so look at this. The same thing they have done. Okay, so 28 lakh, 32 lakh and 16 lakh, the total is 76. Don't you think it's the same thing what we got over here? Simple, right? I don't think this requires any sort of additional explanation. Only thing is, remember, you need not focus on the total. What was the total which I mentioned over here? That was nowhere related to this final answer. Inventory should be valued separately. So product A, cost or net realizable value, whichever is less. Okay, product B, cost or net realizable value, whichever is less. Same way product C, cost or net realizable value, whichever is less. So like that, you will have to individually do the valuation. Clear? So closing inventory will be valued at 76 lakh. Alright, so let's look into this illustration number 5. Z Company Limited purchased goods at the cost of 40 lakh rupees in the month of October 2020 till March 21. 75% of these stocks were sold. Okay, it means 25% is still unsold. The company wants to disclose closing stock at 10 lakh rupees. The expected selling value is 11 lakh rupees and a commission of 10% on sale is payable to the agent. So what is the correct closing stock to be disclosed as on 31st March 2021? Okay, let's solve this. This is illustration number 5. See, those simple illustration I have already explained in the study material itself. Okay, so I will not be writing it in the notes. You guys can just go through it directly. So now the cost of material purchased. How much is the cost of material purchased? It is 40 lakh. Out of this 40 lakh, they have clearly told that 75% is sold. 75% of these goods are sold. So if 75% is sold, okay, so what will be the unsold part? So cost of unsold material, that is nothing but your closing stock. This would be how much? The remaining 25% would be your unsold stock. Okay, so how much would be 25% of this 40 lakh? This would be 10 lakh, right? So this would be 10 lakh. This would be the cost. Now what about net realizable value? Okay, so look at net realizable value. Net realizable value. Okay, so calculation of NRV. Estimated selling price. So what is the estimated selling price which they have given? The expected selling price is 11 lakh rupees. Okay, so from this 11 lakh less estimated cost of completion, okay, and estimated other costs related to sale. Okay, so this is 0, and here if you see expected sale value is 11 lakh and the commission is 10% of the sale. Okay, so commission what they have given over here is 10% of the sale. If this is 11 lakh, so 10% of this particular amount I need to pay it as commission. That would be 1,10,000. So what would be the net realizable value? The net realizable value will be 9,90,000. Okay, this is the net realizable value. Okay, so as per the same point, you guys can just copy paste. Okay, so as per Indian Accounting Standard 2, inventory will be valued either at cost or net realizable value, whichever is less. So here in this case, net realizable value is lower, therefore inventory will be valued at what price? This would be valued at 9,90,000. Check out the solution. Okay, so cost is how much? Cost is 10 lakh and then the net realizable value is 9,90,000, which is lesser than cost. Okay, so therefore inventory will be valued at 9,90,000. Is there any doubt or any confusion relating to this? I hope this is clear. All right, so let's move on to the next illustration, that is illustration number 6. All right, How would you deal with the following in the annual accounts of the company for the year ended 31st March 2021? Okay, so the company has to pay delayed cotton clearing charges over the above negotiated price for asking delayed delivery for the cotton from the suppliers go down. So up to 2019-20, the company has regularly incurred such charges in the valuation of closing stock. Okay, so this being in the nature of interest. Okay, the company had decided to exclude it from the value of the closing stock of valuation. So this would result in decrease in the profit by 7.6 lakh. Okay, so this particular amount, should it be forming part of your inventory or not? That is what they are asking. Alright, now look at the question, understand the question carefully. What are they telling? The company has to pay delayed cotton clearing charges over and above the negotiated price for asking delayed delivery of the cotton from the suppliers go down up to 2019-20. The company has regularly included such charges in the valuation of inventory. This being the nature of interest, okay, the company has decided to exclude it from the closing stock. Normally, when it comes to valuation of inventory, these finance cost and interest, okay, will it be included in the value of the inventory? No. They should not be forming part of my cost of inventory. What the company did is, from the year 2019-20, okay, or till the year 2019-20, the company has been including these particular interest charges. Okay, the delayed cotton delivery is in the form of interest charges. These were forming part of inventory. Now, the company has decided to exclude it, which is in line with Indian Accounting Standard 2, right? They need to exclude it. So, only thing is they just need to exclude it, which they have done. They just need to make a disclosure in the financial statement with respect to reduction in the value of inventory. Okay, so very simple illustration. First thing is just mention, okay, so as per Accounting Standard or Indian Accounting Standard 2, the interest of finance cost should not be forming part of cost of inventory. Okay, till the year 1920, they were wrongly included. Now the company decided to exclude it, okay, which is the right treatment as per Indian Accounting Standard 2. Okay, so this is the right treatment. Only thing is disclosure has to be made with respect to the same. Now check out the solution now. As per Indian Accounting Standard 2, inventories, interest and other borrowing costs are usually considered as not related to bringing the inventory to the present location or condition. Okay, therefore, they will not be forming part of cost of inventory. Look at this. Okay, and therefore usually not included in the cost of inventory. So this particular interest or borrowing cost, they are not considered as costs which are necessary to bring the inventory to the present location or condition. Therefore, they will not be included as a part of the cost of inventory. Thus, it becomes quite clear that delayed cotton clearing charges, which is treated in the nature of interest, must not be included while valuing the closing stock as per the provision of Indian Accounting Standard 2. And it is not in compliance with Indian Accounting Standard 2, which was done up to 1920. Till 1920, they have been wrongly adding it. Okay, so this was not supposed to be included in the cost of inventory, but they were adding it and including it in the cost of inventory, which was the wrong treatment. But from the year 2021, the company decided, okay, so look at this, the company decided to change the earlier view. That is, they decided to exclude the same from the valuation of the closing stock, which is no doubt in compliance with Indian Accounting Standard 2. So from the year 2021, what they decided is, they decided to exclude it. Why? Because it is in the nature of interest and finance cost, and it should not be forming part of cost of inventory, which is the right treatment. Only thing is, you just need to make a disclosure with respect to this reduction of 7.6 lakh. Look at this. As a result of change in accounting policy regarding the valuation of inventory, the profit was reduced by 7.6 lakh. This has to be disclosed. Hope you all understood this. First point, just mention this much. Okay, so any interest cost of finance charge will not be considered as other cost which is necessary for the purpose of bringing the product to the present location or condition. Therefore, it will not be forming part of cost of inventory. Okay, so therefore, it has to be excluded from the cost of inventory. All right. Okay, so let's move on to this illustration number 7. Okay, Sonar Bhandar deals in old color televisions. It has 4 TVs, okay, the particulars of which are given below. You are asked to compute the value of inventory to be included in the balance sheet for the year ended 31st March 2021. Okay, so it has got 4 TVs, Onida, Philips, EC, Sony, and they have given you the total. So cost price is given, expenses incurred to bring it into the saleable condition. Yes, it will be forming part of the cost. Okay, and then the net realizable value is being given. First thing is just add these two. You will get to know the cost, compare it with the net realizable value, and then you will be getting to know how much exactly is the value. And will we be focusing on this total? No. although they give us the total, we'll not be focusing on this particular total. Okay, so let me just quickly show you guys the calculation. Very simple thing, guys. Okay, so when it comes to cost, particulars, okay, so we have got Onida, Philips, EC and Sony. Don't consider the total. Okay, so cost of purchase is been given, and then expenses incurred, okay, to bring the product to the saleable condition. Okay, so add expenses to bring it to saleable condition. Okay, so this will give us the total cost. Okay, so what is cost of purchase? Here it is 10,000, here it is 20,000, here it is 35,000, and finally we have got 50,000. Okay, so what is the expected cost of bringing the product to the present location or condition? So 3,000, 2,000, 5,000 and 0. So what would be the total cost? So total cost over here would be 13, 22, 40 and 50. Okay, this would be the total cost. Okay, now all that we need to do, okay, is just compare this with the net realizable value. Okay, so what is the net realizable value? NRV is being given. So how much is the net realizable value? Do you find this? 18,000, 30,000, 36 and 15,000. So 18,000, 30,000, 36,000 and 55,000. These are the net realizable value. So valuation should be either cost or net realizable value, whichever is less. Okay, so here cost or NRV, whichever is less. Okay, so when you compare these two, which is the lowest amount? So here the lowest is 13,000. I'll just keep on highlighting. So this is the least amount, this is the least amount, this is the least amount, and here this is the least amount. Okay, so inventory will be valued at so and so amount, this and this. Okay, and what about the total? Total valuation would be 1,21,000. Okay, this would be the total valuation, 1,21,000. Okay, so check out the solution. 1,21,000 rupees is the value of the inventory. If you guys would have understood the concept, all these things are just simple calculation. So cost will not be just the cost of purchase, but also the expected expenses to bring the product to the present location or saleable condition. Okay, so yeah, hope you all understood this. This is the total cost. Compare it with the net realizable value, whichever has been given in the question. You will get to know the cost and net realizable value, whichever is least, that would be the value at which I'll be showing the same. Clear? Alright, so let's look into this illustration number 8. The following particulars are presented by M Limited, which is dealing in clothing, as on 31st March 2021. Compute the value of the stock as per Indian Accounting Standard 2. So cost price has been given 10,550, net realizable value is 11,500. The details of such stock has been given over here. Okay, so the total here it is 10,550 and then the net realizable value 11,500. But will we be focusing on the total? No, we just need to calculate individually. Okay, we just need to calculate individually. So here cotton, if you see, the net realizable value is lower. Woolen, if you see, the cost is lower, and again if you see the synthetic product, this is what is lower. Just compare the cost and net realizable value, whichever is less, that is the price at which inventory will be valued. Okay, so quite simple, right? Similar illustration is what we have already discussed. Okay, so let me just write this. Okay, so one illustration I'll just write it so that you guys have a reference. So we have got cost, NRV, valuation. Okay, so valuation will be cost or NRV, whichever is less. Okay, this is how we'll be doing the valuation. Okay, so here we have got three types of product, right? So what are the three different types of product which we have got? We have got cotton, woolen and synthetic. Okay, what is the cost of cotton product? Yeah, so when it comes to cost, it is 5,600, 3,450 and then finally 1,500. What about net realizable value? 4,960. Here we have got 4,540 and then finally we have got 2,000. Okay, so they have also given you the total, but this particular total we need not consider. Okay, so although they are giving you the total, don't consider this particular total and say that this is the least amount, this is the price at which I'll be doing the valuation. No, that would be absolutely wrong. So you will have to compare, okay, the lower of these two. Okay, let me just highlight the lower one. So here it is 4,960, here it is 3,450 and finally over here it is 1,500. So this particular inventory will be valued at cost or net realizable value, whichever is less. Okay, so actual valuation will be 9,910. Okay, so this is the valuation. Okay, so as per Ind AS 2, the inventory shall be valued at rupees 9,910. Okay, so the calculation I have already shown. Look at this, 9,910. This is the value. Cost or net realizable value, whichever is less. Is there any doubt, any confusion? Clear? All right. So let's look into this illustration number 9 now. The total stock of A Limited on 31st March 2021 is 5 lakh, of which stock amounting to 31,000 rupees were not ascertained as per accounting standard 2. Okay, so compute the value of the said stock as per Ind AS 2 for inclusion in the financial statement. So they have given three types of product, P, S and T. They have given you the cost of material, production expenses, selling and distribution expenses and then estimated selling price. Now when it comes to selling and distribution expenses, will I be considering it? No, right? Okay, look at this. Cost of material they have given, production expenses incurred has been given, selling and distribution is been given, estimated selling price has been given. All right. So the cost of material, it is 10,000, 5,000 and 12,000. Production expenses, yes, that would be forming part of my cost. So when I consider the total cost, it is not only the cost of material but also this production expenses. I'll be adding these two. Okay, but will I be adding this selling and distribution overhead? No, right? So selling and distribution expenses to be incurred, okay, it is 1,000, 5,000 and 2,000. Okay, will I be including it in the component of cost? Absolutely not. All right, then they have given you the estimated selling price as 15,000, 14,000, sorry, 4,500 and 18,000. This is not the net realizable value. Don't get confused. This is just the estimated selling price. Now, how do I calculate the net realizable value? I've already given you the formula if you guys can see. Net realizable value will be equal to estimated selling price minus estimated cost of completion minus estimated expenses which is necessary for the purpose of sale. Now, don't you think these are the expenses which are necessary for the purpose of sale? These three items. So, I'll have to deduct it while determining the net realizable value. Okay, so in simple words, what I'll be doing is, look at this. This is illustration number 9, right? Yeah. So look at this illustration number 9. So particulars, they have given you the cost of material and then they have given you the production expenses. Okay, this is cost of material. Production expenses. Okay, so this will give me the total cost. Okay, this will give me the total cost. I just need to add these two in order to figure out the total cost. Now, in order to figure out the net realizable value, okay, so what am I going to do? Estimated selling price. From this, I'll be deducting the selling expenses. Okay, so selling expenses, I'll just be deducting it. Okay, so that I get to know the net realizable value. Okay, this would be the NRV. Okay, suppose this is A and this is B, this is A plus B. Okay, and suppose this is C and this is D, this would be C minus D. Alright, so look at this. So what and all product have they given? They have given three products. Okay, so one is P, S and T. What is the cost of material? 10,000, 5,000 and then 12,000. Okay, so production expenses, it is 2,000, 0 and 3,000. Okay, so total expenses I need to calculate. Okay, so they wouldn't be given. Okay, so they would have just given these items. So estimated selling price, they have given it as 15,000, these figures 15,000, 4,500 and then 18,000. What about the selling expenses? Selling expenses has been given as 1,000, 500 and 2,000. So for the purpose of selling these items, I need to spend so much of amount. Okay, so total cost, how do I calculate this? I just need to add these two. Okay, so this will give me the total cost. Okay, and what about the net realizable value? Estimated selling price, the sale proceed which I'll be receiving minus selling expenses. Okay, so this is how I'll be calculating this net realizable value. Now once I know this cost and net realizable value, I just need to compare these two. Okay, so I know the cost, I also know the net realizable value. Okay, so valuation will be quite simple. Okay, so cost or NRV, whichever is less. Okay, so out of these two, I just need to check out which is the least amount and that would be the valuation. Okay, so here cost are these figures. Okay, so net realizable value are these figures. Just compare 12 or 14, whichever is less. 12,000 is the least amount. Here it would be 4,000 rupees and here it would be 15,000. So valuation will be 12,000 for this, 4,000 for yes, and for T it would be 15,000. Are we focusing on total anywhere? No, right? We are not focusing on the total. Okay, so here we just need not focus on the total. Okay, so valuation will be in this particular manner. If you see everywhere, we are not focusing on the total. Once we are done with the valuation, only then we consider the total. 31,000 rupees will be the valuation of inventory. That is what is this amount. Are you guys able to see this? 31,000. That would be the value of inventory. Anybody having any doubt, any confusion? Clear about this? Yes? Alright, so let's look into this illustration number 10. Let me read this. X Limited presented the following particulars as on 31st March 2021 on the total cost of product. So cost of material, okay, so 12 rupees each. This is the cost per unit. Okay, so cost per unit it is 50. So cost of material, okay, so 12 each, 50 rupees. Manufacturing inputs 30 rupees. Total cost it is 80 rupees. Profit they have given it as 20 rupees. Selling price is 100 rupees. On 31st March, the selling price has gone down suddenly from 100 rupees to 70 rupees. Price of raw material has also gone down to 8 rupees. See, this is just the raw material cost. Okay, so 12 rupees. X Limited had in stock 6,000 units of material which was bought as per the above rate on the same date. Compute the value of inventory. So they're just asking you to calculate the value of the inventory. Quite simple, right? You just need to compare the cost with the net realizable value, whichever is less, that would be the value of your inventory. Now, how much is the cost per unit? Yes. Will you be considering the profit? No. So, for you, the cost is just 80 rupees and net realizable value, if you see, okay, so it has gone down to 70 rupees, 80 or 70, whichever is less. So, inventory will be valued at 70 rupees. How many units? 6,000 units. So, 6,000 into 70, this would be how much? 4.2 lakh. This would be the value of inventory. Okay, I'll just write this. So cost per unit. See, whenever I say cost, I'll not be including the profit margin in it. So total cost is 80 rupees. Okay, so NRV is how much? Net realizable value, they have given that it is reduced to 70 over here. If you guys can see, selling price has gone down suddenly from 100 rupees to 70 rupees. Okay, so closing stock units, how much is the closing stock units? They have given it as 6,000 units. So as per Indian Accounting Standard 2, inventory shall be valued at lower of cost or net realizable value. Okay, so here it is 80 or 70, whichever is less. Okay, so that would be 70. So closing stock value will be how much? 6,000 units into 70 rupees. This would be 4,20,000. Okay, check out the solution. It's the same, right? 4,20,000. Do you find the same? Yes? Alright, so let's look into this next illustration, that is illustration number 11. So state with reference to the accounting standard, how will you be valuing the inventory in the following cases? So raw material were purchased at 100 rupees per kg. Prices of raw materials are on decline. So there is reduction in the value of the raw material. The finished goods, okay, in which the raw material is incorporated is expected to be sold below the cost. Okay, so 10,000 kg of raw material is on the stock at the end of the year. Replacement cost is 80 rupees. At what price will you be valuing the inventory? Look at this. So here there is substantial reduction in the cost, therefore inventory will be valued at 80 rupees. Although the cost over here what they have given is 100 rupees, it will be valued at 80 rupees. Cost is 100 and the net realizable value is expected selling price, which is 80 rupees. Okay, so 80 rupees into 10,000 kgs. Okay, so this would be how much? I think it would be 8 lakh, right? Look at this. As per Indian Accounting Standard 2, materials and other purchases held for the use in the production of inventory are not written down below the cost if the finished product in which they are used or incorporated are expected to be sold at above cost. See, normally here they are talking about the raw material. Raw material and work in progress will be valued at cost. Finished goods will be valued at cost or market net realizable value, whichever is less. But whenever there is permanent fall, so that the selling price, okay, will be lesser than the cost, okay, at that point of time we can reduce these particular raw material below the cost. Okay, that is what is the point which they have told over here. So usually raw material work in progress will be valuing it at cost, but since the finished goods in which these raw material has been used, that will be sold at a price lesser than this particular selling price, therefore we can reduce the value of these material also. Look at this. However, when there has been decline in the price of the material and it is estimated that the cost of the finished product will exceed the net realizable value, the materials are written down to net realizable value. So here 10,000 units is what we have got. So 10,000 units into 80 rupees. Okay, so this would be 8 lakh. 8 lakh is the value at which inventory will be shown. Okay, clear about this sub question 1? Alright, so let's move on to the second sub question. In the production process, normal wastage is 5% of input. So 5,000 metric ton of input were put in the process, resulting into wastage of 300 metric ton. So cost per metric ton of input is 1,000 rupees. So the entire quantity of wastage is a stock at the year end. Okay, so how are we going to value this particular thing? Now, if you literally calculate the normal waste on this 5,000 metric ton, how much should be it? 5,000 into 5% would be how much? 250, right? But what about the actual wastage? It was 300 metric ton. Okay, so look at the solution. So as per Indian Accounting Standard 2, in determination of the cost of inventory, it is appropriate to exclude abnormal item. All the abnormal item, administration expenses, selling expenses, everything are excluded. Remember, things which are excluded: abnormal item, storage cost of the finished goods. Okay, if you see over here, I've given you all these points. Look at this: abnormal item, storage cost of finished goods, administration cost and selling expenses. These are the items which will be excluded from the cost of the inventory. So here also abnormal item we need to exclude it. So input was 5,000, normal loss they have told it as 5%. Okay, so that would be 250. So actual loss was 300 metric ton. Out of 300, if 250 is normal loss, the remaining would be what? The remaining would be abnormal loss. Look at this. Wastage is 300, abnormal loss is what? Out of 300, 250 is my normal loss, 50 metric ton would be my abnormal loss. So cost of 1 metric ton is 1,000. So what would be the cost of these abnormal loss? 1,000 into 50, right? So that would be 50,000. So this 50,000 has to be eliminated. Look at this. So the cost of 250 metric ton should be included in the cost of finished goods, but the cost of entire abnormal waste, 50,000 rupees, should be charged against the P&L account. You already know the treatment of normal loss and abnormal loss, right? So normal loss we charge to the good units, whereas abnormal loss will be charged to P&L account. Same point has been explained over here. All right. So let's look into this third sub question. Per kg finished goods consisted of material cost 100 rupees per kg, direct labor 20 rupees per kg, direct variable production overhead it is 10 rupees, fixed production charges for the year on normal capacity of 1 lakh kg is 10 lakh rupees. 2000 kg of finished goods are sold at the end of the year. Okay, we just need to calculate the value of the inventory. Okay, so very simple thing. You need to add all these things. See, direct material it is 100. Okay, so 100, 20 and 10. So 100, 20, 10 and even this fixed production overhead. Okay, so fixed production overhead for normal capacity, if you see, how much have they given? They are given 10 lakh. Okay, so 10 lakh and normal capacity is 1 lakh kgs. Okay, so this would be 10 lakh divided by 1 lakh kg. This would be like 10 rupees per unit. Okay, so same amount they have just added it as a component of inventory. So total cost of inventory will be how much? This would be 140. So fixed production overhead is 10 rupees. They are talking about this amount, how we got this 10 rupees. Okay, the calculation is right over here. So how much is the inventory? Inventory what we have got is like 2000 kgs, right? So 2000 kg of goods are in stock. Okay, so 2000 into 140 is what we need to do. So 2000 kg is the inventory value into cost per unit is how much? It is 140. So this would be 2,80,000. 2,80,000 rupees would be the value of the inventory. Is this clear? Now let's talk about the last discussion. Okay, not much important again. So the difference between the Accounting Standard 2 and Indian Accounting Standard 2. Indian Accounting Standard 2 deals with subsequent recognition of cost or carrying amount of inventory as expense, whereas Accounting Standard 2 does not deal with it. So Indian Accounting Standard 2 provides separate explanation for inventories of service providers. Accounting Standard 2, there was no disclosure pertaining to providers of service. How exactly are we supposed to account for the valuation of inventory? But Indian Accounting Standard 2 explains about valuation of inventory for service providers. So Indian Accounting Standard 2 does not contain specific explanation for spares which are covered under Indian Accounting Standard 16. So as per Accounting Standard 2, says that the inventory do not include the spare parts, servicing equipment and standby equipment which meet the definition of property, plant and equipment. Few spare parts which are considered as property, plant and equipment or fixed asset, they do not form part of inventory. That has been explained in Accounting Standard 2, whereas Indian Accounting Standard 2 is silent with respect to the same. Okay. So Indian Accounting Standard 2 deals or provides detailed guidance in case of subsequent assessment of net realizable value. It also deals with reversal of the write down of the inventory. So initial year we have already reduced the value of inventory due to reduction in the net realizable value. Subsequently also will be tracking the net realizable value. If it is increased, we need to reverse it. But Accounting Standard 2, we did not have any such valuation. Indian Accounting Standard 2 excludes from its scope only the measurement of the inventory held by the producers of agricultural and forest produce, agricultural produce after harvest and mineral products. However, standard provides guidance on measurement of such inventory, whereas Accounting Standard 2 exclude from its scope such types of inventory. Completely it was excluded when it comes to Accounting Standard 2. Indian Accounting Standard 2 requires the use of consistent cost formulas for all the inventories having similar nature and use to the entity. Accounting Standard 2 specifically provides that the formula used in determination of cost of an item of inventory should reflect the fairest possible approximation to the cost incurred in bringing the item of inventory to the present location or condition. Indian Accounting Standard 2 does not apply to measurement of inventory held by commodity brokers. Okay, so commodity broker trader we already understood, right? So this is not their scope, okay, or this is not included in the scope of Indian Accounting Standard 2, whereas this aspect is not covered when it comes to Accounting Standard 2. Accounting Standard 2 is completely silent with respect to commodities which are held by the commodity broker traders. So Indian Accounting Standard 2 defines fair value as distinguished between net realizable value and fair value. So Accounting Standard 2 does not contain any such definition as such. Clear? So on that note, we just complete this Indian Accounting Standard 2. In the next class, we'll be discussing with the other accounting standards. Okay, so we have got a little more discussion which has been left over. There are quite a lot of stuff which has been left over. So probably another like 3 days we should be able to complete this. Yes. So probably another 3 days we should be able to complete your accounting part. Okay, on that note, we'll just end the class or end the session. Make sure that you guys glance through these illustration whatever we solved relating to Indian Accounting Standard 2. Thank you so much, guys.